Welcome to the Allan Small Financial Show. Thank you, as always, for taking the time out of your busy day to spend some time with us. We have such a special show for all of you today. I had the pleasure of catching up with the Premier of Ontario, Premier Doug Ford. I actually caught up with him on Budget Day about a week ago, just over a week ago now. He was gracious enough to give us some of his time on that day to answer some of the questions that we had for him. Questions on basically the state of the Ontario economy, from infrastructure to interest rates to housing. He touched on all that with us, and we're going to play that interview for all of you right off the top of the show today. But we're also going to get into some other things, as we always do. Here's our list for you all today. Again, the top 3 things that I think are important for every individual to consider before you make your investment decision. So our usual top 3 list. Taking stock of the markets. We just finished our first quarter for 2024. Yes, already quarter 1 is in the books. How did we fare? I think a lot of individual investors know the answer to that. We've actually did quite well in the first quarter. So we'll look at or do a bit of a recap as to how the markets, North American markets, did for all of us. Bank of Canada may have to cut rates first before the U.S. Federal Reserve. And that's pretty, I guess that's an important point. I think if we have to cut rates here in Canada before they do in the US, a lot's going to happen. I think good for business because we're able to sell more to the US, because what will probably happen will be our dollar will fall in value versus the US dollar. And our manufacturing companies and companies in general will be able to sell a little bit more to the US. So if we do cut rates before they do in the US, maybe that's a good thing. Disconnect between economic data and how people are feeling. And this is something I come across all the time. I talk to people and they're not so happy as to where things are at. Their costs are rising. The cost of going out for traveling, buying groceries, their cost to pay their mortgages is going higher. So not feeling a whole lot good about what's happening. But on the other hand, we just keep seeing good economic data, job creation. We're seeing GDP growth starting to pick up again. So on one hand, things aren't going so great if you talk to the people walking the streets of Toronto, for example. But on the other hand, economic data seems strong. So why the disconnect? And I'll get into that. And lastly, as always, I'll take some of your questions. If any of you have any questions regarding my interview with the Premier or anything regarding some of the other topics that we're going to touch on today, please put it into the chat boxes and we will pull those off and answer them at the end of the show. And if we don't get to them this show, as always, I will try and answer them over the next couple of weeks before our next show, or perhaps answer those questions 2 weeks from now on our next show. So without further ado, let's get on with the interview with Premier Ford. Welcome to our show, Ontario Premier Doug Ford. Premier Ford has led the province for the past 5 years, championing himself as a builder. He's building a stronger economy and is attracting new business to the province, including in the areas of electric vehicles and batteries. Prior to being in provincial politics, Premier Ford was a Toronto City Councillor. He's also a successful businessman and owner of Deco Labels. Premier Ford, welcome back to our show. Thanks for being here.
Well, thanks so much for having me, Allan. It's always a pleasure.
Great to see you. I know it's a busy day for you. A lot of action downtown today, and so thanks for taking the time and joining us. I thought we'd start with I guess a general question. The last time you were on our show, which was I think last summer, we spoke about how well the province was doing and how much business and new investment was coming into the province. And since you were on our show, Minister Fedeli was echoing the same statements on a show not too long ago. So I guess my question for you is this, how do we take the province to the next level? What can we do to make things even better? I saw some numbers recently talking about growth in our province. We're going to be somewhere around just over 1% for 2024, at least that's the prediction. But then by next year, we're looking at 2% growth. And then by 2026, they're talking about having close to 3% growth in the province of Ontario. And I think a lot of that is due to the fruits of your labor, bringing a lot of new business. So what can you do, I guess, and what can your administration do to take the province and the growth to the next level?
Yeah. Well, thanks for that, Alan. I've always had a philosophy of, as a government, you have to create the conditions and the opportunities and the environment for companies to come here and invest into the people, into our province, into companies. It's so competitive around the world right now, with large corporations vying for a place to put a facility. And if we aren't competitive, then they're going somewhere else. They're either going down to the US or over in Europe, South America, or over in Asia. And so far, we've created that climate. We've reduced the cost of doing business in Ontario by $8 billion each and every single year. And that's where we're seeing the growth in many sectors, especially the EV sector. We've seen over $28 billion of investment, tens of billions of dollars in the tech sector and life sciences. And the stat I love the most, Alan, Ontario manufacturers last year created more jobs than all 50 US states combined. That just says a lot about our ingenuity, our people, and just the companies that are arriving here on our doorstep to invest. So the other area is obviously infrastructure. We need to focus on infrastructure, and we're spending close to $184 billion. It's probably going to go up to about $190 billion over the next 10 years. And that's getting goods to market sooner, making sure, and everyone's experienced this, the traffic jams, no matter if it's on the 401 or the 400, making sure that we're building new schools. As the previous government closed 600 schools, we're putting $18 billion into building new schools all around the province. And similar to the healthcare sector, hospitals, we're building 50 either new hospitals or additions to hospitals, over $50 billion investment. So we have to continue investing into infrastructure and into people and into technology as well.
Yeah, and and it's funny. Every day I wake up and I turn on my phone and LinkedIn notification pops up, and it's Minister Fideli and yourself at a
Yeah.
new business in Ontario, and you're either welcoming in a new business or you're talking about a new contract that I guess our new
Yeah.
contract, a new business has, bringing in some new business from outside of the country, which is fantastic. And you bring up infrastructure, and I was wondering about that because do we have the people, the labor that we're going to need for these
Yeah.
businesses to set up shop here? Do we have enough workers, enough skilled labor? Do we have enough labor in general to fulfill all the jobs that will be opening as businesses come to Ontario?
Yeah, that's a great question, Alan. Right now, there's 250,000 jobs available, and we're pouring money. We put over $1 billion into skilled trades. That's really where we're short. We need people to get involved in the skilled trades. It's great paying jobs. They're well over $100,000 a year now if you're in a skilled trade, and even goes up from there. Investing into our healthcare workers, no matter if it's nurses, that we've seen over 80,000 nurses registered here in the province since we've been in office, 17,500 alone last year. And I always say you can't have a healthy economy without a healthy population. But to answer your question directly, we need more people, and either skilled or unskilled coming into this country. If they're unskilled, we'll train them up, and if they're skilled, well, they'll have a job literally immediately, multiple jobs. So that's what we're going to focus on, making sure that our province continues to grow, but we support that growth by training people.
And you mentioned already the 401 and the infrastructure, and
Yes.
I was going to ask you, and I guess it's a good segue. I travel the 401 every day, and with the construction, and it's funny, you look back 10 years ago. I'm born and raised in Toronto, and so I remember, 10, 15 years ago, you would drive on the 401 and there'd be cars all around you. Today, the amount of trucks that are going across the 401 on a regular basis through the GTA is just tremendous. And with the construction and the congestion, it's tough. It's tough to get
Yeah.
from one end of the city or one end of the GTA to the other. And is your administration, are you thinking of doing anything to improve the 401? Obviously, the more traffic, the more business, the tougher it is to make deliveries. Is there anything that you could do with the 400 city highways to make things a little easier to get around?
Yeah, another great question. We're expanding, and anywhere you go now, you see construction on the highways everywhere in the province. We're really going to alleviate a lot of the congestion if we build when we build the 413, the Bradford bypass, people coming down on the 400, because more and more people are moving out of the city to get a more affordable homes and inside the city. And we're spending approximately $28 billion alone on making sure that we're expanding highways, no matter if it's Highway 7 from out in Kitchener that people have been promising for 100 years. We're finally the government that's going to get it done. And Highway 3, Highway 11 up north, Highway 11, 17. So there's a lot of construction happening absolutely everywhere. But it goes back to we need more people. We have more projects than we have contractors to build it right now. So we're going to do everything we can to train these workers to get in there and start working. As for the people that are taking transit, we came out with something called One Fare. So for example, you can start on a GO train in Barrie, come all the way down to Union Station, hop on the TTC, head out to Mississauga, all on one fare. It's about $1,600 a year in savings for people. We're building the largest transit system in North America. We're doubling the size of the TTC, the subway system here, building LRTs out in Mississauga, the Hazel McCallion line. So we're trying to get people out of their cars onto rapid transit. And the only way you do that is you build a quality transit system. And that's what we're really focused on, spending about 90 billion in total, including the GO train expansion, all day two-way GO out to areas, no matter if it's Niagara or the Mountain Line and other lines that will really help people.
Yeah, this the one price or one charge for the
One
fare. I
fare,
know.
it's
Yeah, it's
huge.
been a fantastic. I know a lot of individuals, a lot of people that work in my office talking about
Yeah,
that. So that's been great.
that was a
Changing
big
gears
one.
a little bit. Changing gears a little bit. I know your government is committed to accelerating the building of homes,
Yes.
and we spoke about that last July. And I think back then you had said, let's flood the market with as many homes as we can, different price points. That is really the only way to get the price of housing down in Ontario, in and around the
Yeah.
GTA, increase the supply. Are your intentions still the same? Are you still having the same mindset, or has anything changed?
No, I believe in the same philosophy. Let's flood the market, but there's a couple kickers here. One is absolutely critical. The Bank of Canada has to lower their interest rates. If they don't lower their interest rates, people are going to be in deep trouble a year down the road, 2 years down the road when they renew. And if you see the interest rates come down, you're going to see homes pop up like mushrooms all over the province. People are going to be able to afford to put a deposit and buy a home. We put about $1.5 billion, something called the Building Faster Fund. We're actually paying municipalities. We've set targets. We hold them accountable if they don't, and if they do, they get rewarded with a big check. And we've been traveling around the province handing out checks, but to enable them to focus on infrastructure, because some areas, not all, but some areas can't build because the infrastructure is not there, the water, the sewer, treatment plants, and now they're going to have an opportunity to build. So we're pouring money into infrastructure. Made an announcement last week. Largest infrastructure funding in the history of this country, over $3 billion for communities around our province to enable them to build homes.
Are you finding it difficult in terms of space to find space to build the homes, or is there still a lot of space out there that still can be used?
Well, there's space, but I'll give you an example. TOCs, we call them transit-oriented communities. When you have a subway, you have to build density around the subway stops. But out in the rural areas, as long as they have the infrastructure, they'll be able to build. So we're confident we're going to make sure we hit our targets, the 1.5 million homes that we said over the next 10 years. But it all comes down to having a great partnership with municipalities, all 444 of them, and working with them hand in hand. And obviously the key kicker again is that Bank of Canada interest rate.
Yeah, for sure. And with rates as high as they are, they've been hopefully coming down at some point, but they seem to be kicking the can down the road a little bit with
It's frustrating. It
the
is
lowering.
frustrating. You know, they first said, not to get deep into the weeds here, but they told everyone as long as the inflation falls below 3%, we'll lower them. Well, it fell down to 2.9, then it went down to 2.8, and they're still, dragging their heels there.
Yeah, it's difficult, and I guess leading from that, a lot of Ontarians, a lot of Canadians in general, doing their taxes right now, right, filing their tax return in the next month or so, and we're all now figuring out how much we've paid in tax, how much we need still to pay in more tax by
Yeah,
the end of April. You couple that with, as we said, higher interest rates, higher costs in general. It's getting tough for a lot of Ontarians
is it
to carry
ever?
the debt that they have. So
Yeah.
I guess, just continuing from our conversation, what would you say to Ontarians today? Is there anything that you could do, your administration can do to lower maybe some of the tax burden on some of these individuals? Because it's a question I get all the time, Alan, what can we do to lower our taxes? And
Yeah,
unfortunately, it's only RSPs that they can do, but
that's
outside of
right.
that, there's not much else.
Yeah, well, you know something, I hate taxes. I really hate them. And it just takes money out of people's pockets. I have a little philosophy that you keep money into people's pockets. They'll go out and we'll go out for dinner, buy a piece of furniture, put a renovation on. And if they have less money in their pockets, they aren't going to do that. So the really good news is we've never raised a tax. Think of that, Alan. We've never raised a tax on businesses or people in 5.5 years. We don't plan on it. We plan on getting revenue through growth, and we've seen growth. Our budget when we first walked through Queens Park was 150 billion. We grew revenues by 52 billion dollars through growth, not through raising taxes, through economic development and prosperity. But I get it. I hear it all the time, Alan. People are struggling right now, no matter if it's the high fuel cost, and we're going to see the federal government jack up the carbon tax, which is just, you can't even comprehend why they do that. Increasing carbon tax by 23%, taking more money out of the pockets of people because everything gets delivered. The food gets delivered to the stores on these trucks. They go get delivered products on trains and planes, but they're just gouging the people. It's unacceptable. I'll never raise a tax. I don't believe in taxes. I believe in growth and revenue. But I'll tell you, I hear it all the time. Three key things: affordable rent or homes, affordable groceries, and affordable fuel. Those are the three key areas. And we're able to knock the price down on the gas as the federal government is raising the tax. I just announced the other day we're going to freeze the tax cut 10.7 cents. Again, moving forward all the way to the end of this year, that saves people $320. The one fare saves people $1,600. The sticker license fee saves a few $100s. Getting rid of the tolls, that saves people a few $100s. It all adds up. My job as premier is to make sure that we're prudent fiscal managers with the taxpayers' money, and that I'm always looking at ways to reduce cost, not increase cost. Because the easy thing for any government, I see it over and over again, is just to increase taxes and blame someone else. There's no reason to raise taxes. When Rob and I were down at City Hall, the first day I walked through the office with Rob, they said, you have $774 million of pressure. You have to raise taxes 20%. We looked at each other. We thought, we aren't raising taxes. We drove efficiencies and delivered a 0% tax increase the first year, saved the taxpayers $1 billion. And it's just any government that says you got to raise taxes, you need a new government.
Yeah, it's as you said, I think you told us last show, it's not an income problem, it's a spend problem a lot of times. So
100% it is.
yeah, and you think these extra taxes, what does that do to inflation? And therefore, the Bank of Canada,
Yeah.
and they come back and say our hands are tied because the inflation levels don't come down. So
Yeah, and
it's
energy too. Yeah,
yeah,
energy cost drives up inflation as well.
yeah, just
So,
snowballs. My last question I thought would be an interesting one for you,
right.
maybe one that you don't get too often. And obviously, as we all know in the US, they're having a big election in November, very important to all of us in Ontario, as Minister Fideli mentioned, that we are now the third largest trading partner, Ontario alone, to the
Yeah.
United States. So the election is going to be pretty big down there, who wins and whatnot. But a lot of what's going on down there right now, a lot of conversation is around a wealth tax. Democrats and current administration believe the wealthiest don't pay their fair share. So I thought it would be interesting to end on a question with yourself and see what you feel, or how you feel about a wealth tax. How do you feel about increasing the tax on the wealthiest Ontarians? Would that be something that you would consider? And what is your, I guess, feeling about this whole notion of a wealth tax?
I'm dead against it. I'm dead against taxes, no matter if it's the poorest or the wealthiest. Keep in mind, previous governments tried this, and guess what happened? The previous government lost 300,000 jobs because wealthy people are not stupid people. They don't see a return on investment. Guess what? They lift their money up and they invest it somewhere else in the world, or even within the country. I believe in job creators, and a lot of them are job creators that allow people to have a better job and a bigger paycheck at the end of the day. So we can't drive investment out of this province. We have to encourage wealthier people all over the world. Guess what? There's a place called Ontario. We're open for business. We keep our taxes low, and please come invest, put your facility here, employ people, great paying jobs, and that's how you grow the economy. You don't tax people, especially the wealthiest people, because I can guarantee you, we've seen it before, they will take their money out of this province as quicker than you can say your name. So taxes are just a poison when it comes to, with me. I can't stand them. It doesn't create growth and wealth on any sector, no matter if you don't have a large income or medium or small income. Taxes are the worst thing you could do to people.
Yes, I agree, and I think many would agree with you. Premier Ford, I want to thank you so much for taking the time out of a busy day for you, I know, and for being with us here today, this afternoon. All the best. Good luck for the rest of the afternoon. It's been a pleasure having you, and look forward to talking with you again down the road.
Yeah, I really look forward to it. Thanks so much. Appreciate it.
Premier, take care.
Thanks,
all the best.
Allan. Okay, all the best. Thank you.
What a great interview that was. I guess my favorite thing, I think for many people listening to that interview, was right at the end when we spoke about taxes and how the Premier does not like taxes, doesn't think taxes create wealth or create anything, and talking about how he's never raised taxes in the province since he's been in power, and doesn't plan on doing it going forward. So that's good to hear, especially this time of year when all of us are figuring out how much tax we owe by the end of April. So a great interview, and hopefully everyone had a chance to listen. Now we come to the part of the show where I talk about what I think individual investors should be considering before they make their investment decisions. And as usual, we have our list of 3 topics. And these are, for this show, economic indicators or economic data. And these are the data that I guess we all focus on, or we should be focusing on, the data that tells us what's going on with inflation and growth in general. And always seems to be on our list. But once you get through earnings season, and we're about to enter into a new earnings season, as the first quarter has now ended, between the 2 earnings seasons, well, we tend to focus back on the macro, the economic data for the country, and why that's so important for things such as interest rates. So we'll talk about economic indicators or economic data. 1 cut or 2. What I mean by that is cut in interest rates. Coming into this year, the market actually anticipated as many as 5 or 6 interest rate cuts. Now the market is anticipating maybe just 3 cuts. And from some of the conversations I've heard from Federal Reserve governors, maybe 1 or 2 is now the new number to consider. So we'll speak about that and why that's important to focus on. And my third point is patience. How many times have someone told you to have more patience? Well, this is patience in investing. Don't go off and chase the market higher. Don't go off and chase certain stocks higher. Have some patience. There are a lot of opportunities out there. If you don't find one right away, have some patience. Look to other areas or perhaps other ideas in the same sector and have some patience and perhaps do some homework to find some good quality names. So let's move on with our first point, which is economic indicators or economic data. And we actually received today the producer price index report out of the U.S. and showed us that things are coming in a little bit hotter. Sorry, we actually received private payrolls. Producer price index we received a few weeks ago. Private payrolls we received today. These are job growth from private companies. And that number came in a little bit higher, a little bit hotter than anticipated this morning. Now, do I think that you can extrapolate from the private payrolls to the non-farm payrolls on Friday? Sometimes you can, but a lot of times those numbers actually don't go together well. And we're going to get a jobs data out of Canada and the US on Friday, the non-farms payroll. And we're expecting out of the US approximately, about 215,000 jobs created. And again, I always focus on the US a little bit more than Canada because the market tends to move with US economic data more so than Canadian data. So we're going to get a number on Friday, and it's going to tell us with the story about jobs. Obviously, the more jobs created, the more money people are making, and therefore, in most people's opinions and the opinion of the Federal Reserve, the more difficult inflation may be to start to see it come down further. When people are spending more and more because they are employed and have jobs, that tends to be impacted negatively on the inflation number. Inflation tends to stay stubbornly high or go even higher. So we're going to get a jobs report on Friday. Then next week, I believe on Wednesday, we're going to get an inflation number out of the US. Once again, a crucial number. We've seen inflation tick a little bit higher in the first quarter from what was expected. Many were hoping that we would see inflation with a 2 handle in front of it, or starting with a 2. We still see inflation just above 3% in the US. So we're going to get inflation numbers on Wednesday, and not necessarily economic data, but we're going to get a Bank of Canada announcement on interest rates next week as well. So a lot of important data points to focus on if you're an individual investor over the next few weeks. We have a couple of charts here that I'd like to show. The first one is on Canadian employment change, a nice bar chart here. For some of you that can see the top writing, it just goes into jobs here in Canada. We grew over 40,000 jobs in the month of February, and that was actually higher than the 37,000 jobs created for the month of January. So we're seeing a spike. You can see it here on the far right on the bar chart. The last 2 months have definitely moved significantly higher on the jobs front here in our country. Is that a sign of perhaps more growth to come down the road? Well, we have a GDP chart that will show you that, and I will show that shortly. But before I do, let's go into the U.S. Jobs growth on a monthly basis. And you can see here in February, 275,000 jobs created, above what we saw in January. Not quite matching what we saw in December, but again, very strong numbers. And when the Fed sees these numbers, it gets a little concerned because wondering how the inflation rate will pull back when people are spending a lot more money. Here you have the next chart, U.S. Consumer Price Index, and we can see here that the inflation rate in the U.S. 3.2%. The core rate, when you take out volatile food and energy, looking at around 3.8%. Once again, those numbers kind of flatline. We saw them come down very rapidly, but they've been in and around just over 3% on the headline number and 3.8% on the core number for a little bit now, for a number of months. Quickly here, we have our next chart, which is the Canadian inflation numbers, core inflation in Canada. Actually, this is Canada's headline inflation eases to an 8-month low. We're seeing at 2.8%. Core is around there as well. Core inflation rate similar, but you can see here that the interest rate in Canada, Bank of Canada rate is 5%. So a very big gap between where inflation sits today and where the Bank of Canada has the interest rates for the moment. And in talking or hearing Bank of Canada speak, you don't really anticipate them moving on interest rates anytime soon. So again, keeping, I guess, one eye on markets, but also another eye on the economic data that's coming out and how it's going to in fact affect the inflation rate, how it's going to affect interest rates, which obviously affect the stock market. Very important for individual investors to consider. Basically, the next point that I wanted individual investors to consider before you make your investment decisions is this idea of how many interest rate cuts we will see or receive in 2024. More so again on the Federal Reserve side. We've heard Federal Reserve governors recently talking a bit about how once upon a time they saw 3 cuts. Maybe now they're only seeing 1 or 2 interest rate cuts. Although if you listen to the Federal Reserve, the head of the Fed, which is Jerome Powell, in his last speech, he still maintained that he could see 3 interest rate cuts here or in the United States. Bank of Canada as well. Market is anticipating the Bank of Canada cutting rates 3 times. But once again, I think the market is starting to grapple with this idea that the longer it goes before we get that first rate cut, the less likely we're going to see a number of them this year. We may only see 1 or 2. And recently I heard from an economist, an analyst, saying that we may not get a rate cut at all in the US this year. And in Canada, we may see only 1 or 2. We have I think one of my favorite charts of the show, of the week, is the chart we have here about changes in the Bank of Canada policy rate. And you can see here that the upcoming meeting on next Wednesday, there's basically an 83% chance that the Bank of Canada is going to do nothing. Only a 17% chance that they could lower a 1/4 point. But when you go out to the next meeting, which is the beginning of June, right now there's just under a 75% chance we could get that first rate cut. And that's what the market is pricing in here in our country. Not until September where the market is starting to price in a second rate cut, again, about a 73% chance. And the third rate cut that the market is anticipating, they're anticipating, or the markets are anticipating, this won't happen until December, the December Bank of Canada meeting, whereby almost 90% the market is saying that a 1/4 point cut will happen. So to me, it is something that the market has been anticipating. Once upon a time, it was anticipating more rate cuts. We seem to be getting the idea that perhaps central banks will cut rates less and less as the economic data remains strong, as inflation remains stubbornly high in and around that 3% rate. As we know, Bank of Canada, Federal Reserve wants to see a 2% rate. So as inflation stays high, as the data stays strong, tough to cut rates in that type of environment. We have another chart here, inflation and the Fed funds rate. This is core CPI, and you can see how the core CPI has come down, that the Fed funds rate is well above core CPI on the far right-hand side. And lastly here, our last chart of this idea of 1 rate cut or 2 is the Treasury yield and federal funds rate. And I think the most important thing to take away from this, as the Fed's funds rate, as the central bank rate started to rise or continue to rise significantly and very sharply, so did Treasury rates. The 2-year in the US now, probably about 470 today. When we took this chart, it was just under 460. The 10-year closer to 440 now versus 4.2%. So rates going higher, not a good thing for the market. Something to watch for, to listen for when you hear these Federal Reserve governors speak. Are they talking 3 rate cuts, 2, 1, or maybe none? The last point I wanted to discuss, the third point with regards to what individual investors should be focusing on and have before you make your investment decisions, as you can see here, is patience. When the market is trading at all-time highs, which we just came off of, a strong first quarter, you need to have patience. You can't just go out and chase individual investment ideas because they've been working. You need to evaluate them. You need to do your research. Perhaps there's another idea in the same sector that is better for you today. And maybe you should hold off buying something. Now, as you all know, I never say to market time, never time markets. If you want to buy something, if you have the money to buy, go out and make that purchase and invest. But there's a difference between buying something that is overvalued and buying something that is have good value or right value on an investment idea. I have a few examples of some charts on some stocks that have done really well, but perhaps you could take a look at some other ideas. And the first one is Eli Lilly. Some of you may know Eli Lilly, big pharma company in the US, diabetes drugs, weight loss drugs, Alzheimer's. They're doing it all right now. The stock has been tremendous, one of the 10 largest companies in the world today. But Eli Lilly, as I look to my notes, Eli Lilly trades at 62 times forward earnings. Pharmaceutical company, does it deserve to have that kind of premium? Perhaps, but maybe you look elsewhere. Maybe you look at a name like Pfizer. Pfizer is a name we all know, COVID vaccines, etc., Viagra, all the different drugs that Pfizer has offered over the years. Well, Pfizer, they trade at 12 times forward earnings, much cheaper. Obviously not doing as well as an Eli Lilly right now, so cheaper for a reason perhaps, but they just made an acquisition. They're moving into the oncology cancer research area. Pfizer also, as I said, trades only 12 times earnings and pays over a 6% dividend today, which I think for now is secure. So you could earn 6% on a very large pharmaceutical company. So another idea, do you chase Eli Lilly or do you buy something a little cheaper with a good dividend? Another example of a stock would be Micron. I thought I'd bring to you something in the chip space. Micron produces chips for memory, and Micron's had a fantastic run, trading at all-time new highs. But as my notes tell me here, Micron is trading at 154 times forward earnings, well over 100 times earnings for Micron. Now, I don't know about you, but that's not a name that I necessarily want to chase. I think if you own it, perhaps you continue to hold it, maybe you trim some profits, which I've done for some clients. But instead of owning Micron and a name that has done extremely well, why not own NVIDIA? We've talked about this name many, many times. We have a chart on NVIDIA. NVIDIA has gone up more than Micron has. And NVIDIA trades 35 times earnings. Still a little expensive, but for a company that's growing as quickly as it is, I don't think it's as expensive as anywhere near a name like Micron or a name like AMD, some of the other chip makers in the space. NVIDIA actually cheaper today, as I've said, than it was a year ago. So again, have some patience. Don't chase some of these high flyers. Buy something that's good quality and a little bit cheaper. Another name, Apple. We have a chart of Apple. I've talked about Apple. Apple trades somewhere around, let's call it 26 times earnings today, down from about 30 times earnings. And Apple's a name that is growing high single digits only, paying 26 times for a company that's only growing earnings, 6 to 10%. Instead of Apple, have some patience. Don't chase it. Maybe you buy a name like Alphabet or Google. Google trades at just over 20 times earnings, a little bit cheaper. A stock that hasn't, in my opinion, reached anywhere near its potential with respect to its artificial intelligence. There's rumors that Apple's going to be using Google's or Alphabet's artificial intelligence for their products. So rumors that these two companies will team up in the not so distant future. So again, having some patience, looking at buying some names that are maybe in the same sector, but are a little bit cheaper. And lastly, I have a chart here on Invesco QQQ. This is the chart that basically follows the tech space, and you can see how well tech has done. And the reason why I put this up is not because I want you to time the market at all in any way whatsoever, but you can see how well a number of the investments have done. A lot of these are tech names, obviously. And if you have some patience, if you look for some of those diamonds in the rough, you can gain exposure to the space and still do quite well, even after a lot of these names have gone up, and even after, a lot of these indices have gone significantly higher. Taking stock of the market, how have the markets done for the first quarter of this year? Well, first of all, markets have done extremely well. The S&P 500, the largest index in North America, up 10.5% over the first quarter. The NASDAQ, which outperformed everything last year, up 9.5%. How has the Toronto Stock Exchange done this year? At least so far, first quarter, 6.5% growth. So the markets are doing extremely well. And it's interesting, when you look at the S&P 500, not a lot has changed, unfortunately. Technology still makes up most of the growth. NVIDIA still makes up most of the growth. NVIDIA is up over 80% in the first quarter of this year. If you own the stock, it's up over 80%, making up half the gains of the S&P 500 itself. So out of the 10.5 or so percent, NVIDIA made up almost 5% of that gain. So again, it's been a tech-led rally. We talk about the saying, sell in May and go away. And that's the idea that individual investors come to May, they sell their investments before they go on their summer vacation, only to come back in October and buy back in. And when I guess the kids are back in school and everything gets ramped up again. Well, that is something that may work this year. It's not a saying I follow. I never just sell in May and go away just because people have coined the phrase, but it actually Yeah. Hi, I apologize. We've lost power in our offices, and for those of you that are still on the show, I do apologize. There's a storm here in Toronto and wiped out all our electricity in our offices. So I'm actually going to talk to you a bit from my phone. And yeah, it is a little unexpected. That's what happens when you do a live show. So I apologize, but we'll move on with the show as best as we can. So I apologize for the disruption. And I guess, Phil, if we can get on to the next topic, that would be great. We can go to the next topic, topic number 5. That would be great. So the Bank of Canada, we may have to cut interest rates before the United States. And that is, I guess, something that could affect our dollar. That is something that could affect the markets in general, depending on what sector of the market. I know that the data coming out of Canada is weaker. We're not seeing as much growth here in our country. We're looking at about a 1.1% GDP rate or GDP growth versus the United States, which is coming in somewhere around 3% growth for this first quarter. That is the estimate. Actually, the Atlanta Fed has it around 2.8%. And the idea that the Bank of Canada may have to cut rates, as I said earlier on the show, that perhaps could affect our dollar. Our dollar could start to weaken. Good for our manufacturers that will be sending goods to the United States, but not so good for our I guess for those that are traveling and for those that are wanting to go down to the U.S. We have I believe a graph or a chart on that. Our first chart you can put up, Phil. I'll take my glasses here, and this shows basically GDP in Canada, and you can see how, as I mentioned earlier, GDP actually has spiked early this year, coming off some disappointing data for I guess at the end of last year. But GDP is definitely has rebounded, and the idea that because things are so strong in the U.S., we're seeing jobs growth, we're seeing GDP growth, we're seeing retail sales stay strong. I think a lot of corporations are telling us, a lot of the retailers are telling us that things are starting to slow down. We just saw some data out of the parent of Calvin Klein, for example, tell us that individual individual data is starting to slow down. But yet, overall, economic data in general has been doing well in the U.S., whereas here in our country, not as well. We're seeing unemployment numbers, for example, in the province of Ontario, is moving a little bit higher. And so overall, if we continue to see inflation in our province fall, and I think we have a next chart on that, 2.8% is where our inflation data is right now. Overall, we're compared to the U.S., they're just over 3%. So we seem to be seeing inflation coming down a little quicker. Here we have real GDP by industry. There you have the charts on that. You can see that things are picking up a little bit, but overall, the pace of growth is not as great here. And the talk is that with mortgage interest rates as high as they are, with costs rising, with I guess expenses rising, and it's just a little bit more difficult now because we're not seeing the growth here in our country as compared to the U.S., that we could get the Bank of Canada cutting rates a little bit before the United States. I'm not sure how many meetings before, but the idea right now from both central banks is that both of them will cut 3 times, although I would probably say that if I had to guess, I would probably bet that the Bank of Canada may cut 2 or 3 times, whereas the Federal Reserve may be left to cut once or twice. So overall, I would say look for the Bank of Canada to cut rates perhaps sooner, perhaps more often this year than the U.S., and what the effects on the stock market might be. But also, more importantly, I think the number one effect will be on the Canadian dollar itself. So we often talk about the disconnect between the economic data and what people are feeling and what they're doing in currently. And when you talk to people, as I do here in the city of Toronto, most people are unfortunately a little bit negative. They're negative with respect to how much money they're paying for their groceries, how much money they're paying to fill up their cars, how much money they're paying to go on a vacation. How much they're paying in interest on their mortgage. And so for me, it's hearing what they're saying and basically the actual economic data that are receiving, the economic data that we're receiving sometimes is very different. And what we're receiving in economic data shows us that the country in Canada is doing okay. In the United States, they're doing a lot better than we are here. As you can see behind me, everything's coming back on. The lighting is coming back on. Overall, it's difficult. And I think the reason, or the main reason for the disconnect between the economic data, the disconnect between what people are feeling, it really comes down to a couple of things. And that is investing. I think those that are investing in the markets, I think they feel a lot better than those that are not. I think those that own their own home, they may have a mortgage on it, but if they have equity in their home and they see their housing price or the price of their home rising over time, I think that's a lot better as well. Those people are in better shape than those that are perhaps renting and seeing their rents rise by quite a bit. So overall, I think the disconnect comes from, and this wealth creation idea comes from those that are investing, which they've been seeing stock markets at all-time highs. If you've been an investor over the last couple of years, you've seen a down market followed by a pretty large uptrend. And I think that has helped a lot of people get by during these difficult times, during these times of higher inflation, higher interest rates, and perhaps slower growth here in our country. I know we have one chart that we could show on the wealth effect. Here it is. And I can take my glasses here and you could see basically the wealth effect here, distribution of household wealth, and you can see the most wealthy have never been wealthier. The wealth effect is doing extremely well, and you can see that the ones at the bottom, unfortunately, in 2011 were one of the slowest wealth creation. And overall, to me, it's all about investing. You want to invest to get ahead in life. We all work to put food on the table, but we invest to get ahead. And to me, those that are able to invest to get ahead, those are the ones that I think will benefit. And in my opinion, those are the ones that will be able to handle this higher cost and higher pricing going forward. Now the part of the show where I take some questions. It's been I guess, a very interesting show. I'm glad we were able to get the Premier's interview on before we lost power today. It's as I said, for those in Toronto, it's been a stormy day. The one question that I saw that came in before I lost power here was a question about whether or not I tend to be an active or passive investor. And I guess the simple answer to that question is I am an active investor. I believe in active investing. The passive investing is something for those that perhaps don't have the ability or the skills or the time to do their own research, to research investment ideas. I think that if you're a passive investor, you're one that maybe not know whether to buy Google or Meta, or whether to buy Apple or Microsoft. So what do? You buy a passive index or an ETF, and they would own all of them. And so for me, I've always been an active investor. I do try to pick the winners from the losers over time, and that's what I do here. So with that, I want to say thank you for all of you that hung in there. As I said, it's a live show, live TV here, live digital TV. And sometimes things happen that are uncontrollable, like losing power on the show. And hopefully all of you got something from the show. Hopefully something got something from the premiere. And as I said, if anyone has any questions, please feel free to send them to us. I'll be happy to answer your questions before the next show. And our next show will air on April the 17th, 12 noon, which is a Wednesday. And until then, happy investing.